the 2026 market crash. Many will panic, losing faith in the system. Others will make billions. Why? Because it's not just a crash, it's an opportunity. The markets don't just collapse, they reveal the deeper patterns of leverage, inequality, and trust. For the savvy, the crash becomes a goldmine. This is a story of what happens when systems break, and how you can turn that breakdown into an unimaginable windfall. Let's begin. The path to the 2026 market crash is already laid. The world has been living on borrowed time, propped up by debt. And like every great illusion, it's bound to collapse. The world is built on credit. Debt, borrowed and lent, is the foundation upon which modern economies stand. Over the last decade, we've seen a global boom, fueled by cheap money and easy credit. Central banks flooded the market with liquidity. The result? A massive surge in asset prices. Stocks, bonds, and real estate, all inflated by the illusion of wealth. But debt is not wealth. It never was. The numbers don't lie. Debt can only go so far before the pressure becomes too much. And that pressure is building. The global debt-to-GDP ratio is at an all-time high. Governments, businesses, and individuals have all borrowed beyond their means, counting on an ever-rising tide to keep them afloat. But a rising tide only covers so much. Then the cracks started to show. The first signs were subtle. Interest rates began to climb. The cost of borrowing went up. For those already deep in debt, this was a warning. For others, it was a signal to pull back. But for most, it was ignored. The system is fragile. It has been for a while. As long as interest rates remain low, the illusion holds. But the moment rates rise, the illusion starts to fall apart. The debt cycle is unsustainable. The path to the crash is inevitable. This isn't just a cyclical correction. It's the inevitable consequence of a financial system built on leverage. We will come back to this, the unsustainable leverage that will send the system into freefall. But first, let's look at the mechanics of the crash. Leverage is the fuel of this financial engine. But like all powerful engines, it can destroy everything in its path when it overheats. Leverage works like a magnifying glass. It takes a small shift and turns it into something catastrophic. When you borrow, you're borrowing the future. The markets have been on a borrowed timeline, using debt to push returns higher, inflating everything. A dollar borrowed becomes several dollars of investment. The more you borrow, the higher your returns. But it's also a ticking bomb. It's not just investors who are borrowing. Governments and central banks have been playing the same game, thinking they can manage the pressure. But there's a limit to how much debt a system can absorb. We're reaching that limit. The system thrives on the concept of rolling over debt. The idea is simple. Take out new loans to pay off old ones. But what happens when the new loans dry up, or when they cost too much to service? That's when the cracks appear. It's the equivalent of a high-speed chase with no brakes. The system is running on borrowed time. Every new loan pushes us closer to the edge. And here's where leverage plays its most destructive role. Small changes in interest rates, small changes in market sentiment, these become magnified. Leverage doesn't just make you rich, it makes you vulnerable. When things go wrong, they go very wrong, very quickly. We'll come back to this in a moment. The point at which leverage turns from an advantage into a destructive force. But first, let's take a look at the growing inequality in the system. It's not just debt that's distorting reality. It's who holds the wealth and who doesn't. The crash isn't just about money. It's about power. And when the market falls, it's the powerless who suffer the most. We live in a world where wealth is not just accumulated, it's concentrated. The top 1% hold more wealth than the bottom 90% combined. And this isn't just about the size of the pie, it's about who gets to eat. The system is rigged to favor those at the top, and when the market crashes, they stand to benefit the most. How? Through leverage. The wealthy have access to cheaper, more abundant credit. They can take on greater risk because they have the means to absorb losses, while the rest of us are left holding the bag. When the market falls, it's the poor who lose their homes, their jobs, and their savings. But for the wealthy, the collapse presents an opportunity to buy up distressed assets at pennies on the dollar. The divide between the rich and the rest has been widening for decades. This isn't just about income, it's about access. The wealthy have access to insider deals, to the kind of leverage that allows them to profit off others' suffering. As the market falls, they'll swoop in, picking up assets for a fraction of their true value. The crash isn't a setback for them. It's a chance to consolidate power. But while the elite profit, the rest of the world suffers. It's the inequality built into the system that makes the crash so much worse. The average person won't just lose their savings, they'll lose faith in the system altogether. And that's where the real danger lies: the collapse of trust. We'll come back to that in a moment. How the system is designed to benefit the few while the many are left exposed. But first, let's look at the illusion that keeps this whole system running, the belief that everything is stable. Let's explore the myth of stability. The system doesn't just rely on numbers, it relies on belief. Trust is the foundation. But trust is fragile. For decades, the markets have thrived on one simple thing: confidence. Confidence in the system, in the people running it, in the promise of endless growth. As long as people believe in the markets, they'll keep investing, no matter how high the risks get. But what happens when that trust breaks? What happens when belief in the system erodes? The whole thing starts to unravel. Markets aren't driven by logic. They're driven by sentiment. The price of assets rises because people believe they will rise. This belief, this collective trust, creates a self-fulfilling prophecy. The more people invest, the higher the prices go. But once confidence starts to waver, everything begins to fall apart. Prices drop, investors panic, and trust shatters. This isn't just a minor shift. When trust breaks, the floodgates open. Investors flee. Governments scramble to save the system, but it's already too late. The crash isn't just about losing money. It's about losing faith. The financial system is a fragile web of beliefs, and when those beliefs break, everything does. What happens when trust fails? It's not just the markets that collapse. It's the entire framework that has kept this system going. But here's the thing: the illusion of stability isn't just built on confidence. It's also built on inequality. And the crash we're heading toward is as much about the unequal distribution of power as it is about economic instability. We'll come back to that. How the collapse of trust reveals the cracks in the system, and how these cracks have been there all along. But for now, let's take a look at the mechanics behind this crash. The way modern tools of finance, apps, derivatives and high-frequency trading make this collapse not just likely, but inevitable. The financial system of today is nothing like the one that collapsed in 1929. But the mechanics? They're eerily familiar. In the past, the markets were relatively simple. You had buyers, sellers, and the occasional crisis. But today's markets are a different beast. The tools we use to trade, to invest, and to leverage money have evolved, but they've only made the system more fragile. What once took weeks to execute can now be done in milliseconds. What was once an isolated problem can now become a global contagion in a matter of hours. Take derivatives, for example. These financial instruments are designed to hedge risk, but in reality they do the opposite. They amplify it. Derivatives have allowed investors to take on enormous amounts of risk with minimal capital. The leverage is staggering, and when one of these derivatives goes wrong, when the bets don't pay off, it can trigger a chain reaction across the entire market. Apps and high-frequency trading have compounded this issue. Algorithms designed to trade in fractions of a second now drive the market's every move. The machines make the decisions that once required human oversight and caution. When the algorithms go wrong, they do so at a speed no human can control. What happens when the machines panic? The collapse of 2008 was bad enough. But the next crash, it's not just about asset prices dropping. It's about a global system suddenly going silent, like the flicker of a light bulb before it goes out. We'll come back to this, the true cost of automation in finance and the massive risks hidden in plain sight. But first, let's examine the speed and reach of this collapse. The interconnectedness of today's world means that a problem in one market can become a crisis in another in a matter of hours. The contagion will spread fast, and it won't stop at national borders. When the markets collapse, most will panic. But the few who understand the system will see opportunity in the chaos. The market crash is inevitable. The signs are everywhere: rising debt, crumbling trust, and the fragility of an interconnected, high-speed financial system. But here's the truth that few will acknowledge. The crash is not the end. For some, it's just the beginning. While the masses scramble to salvage what they can, the savvy investor will seize the moment. Crashes are where fortunes are made, not lost. The key is timing and understanding that a market crash isn't the collapse of wealth, it's the redistribution of it.